Good morning, everyone. Hopefully, y'all are having a great Tuesday. Fed Chair Powell is currently speaking, talking about the central bank independence from political pressures. So, this has been a non event so far this morning. We're actually getting a little bit of a relief rally so far out of it. The markets are about to open in 2 minutes, so we'll see the real reaction versus the pre market reaction is sometimes a little bit different. But right now, not really moving much at all. I'll try to actually make it to where y'all can hear what Powell is speaking, then I'll turn myself off. But and at the end, I'll give my remarks. So let me fix my audio to where I can output it to y'all. Output.
In the area of bank regulation, as Tobias mentioned, the Fed has a degree of independence, as do the other federal bank regulators. Independence in this area helps ensure that the public can be confident that our supervisory decisions are not influenced by political considerations. And today, some analysts ask whether incorporating into bank supervision the perceived risks associated with climate change is appropriate, wise, and consistent with our existing mandates. Addressing climate change seems likely to require policies that would have significant distributional and other effects on companies, on industries, on regions, and on nations. Decisions about policies to directly address climate change should be made by the elected branches of government and thus reflect the public's will as expressed through elections. At the same time, in my view, the Fed does have a narrow but important responsibilities regarding climate-related financial risks. These responsibilities are tightly linked to our responsibilities for bank supervision. The public reasonably expects supervisors to require that banks understand and can appropriately manage their material risks, including the financial risks of climate change. But without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools, for example, to promote a greener economy or to achieve other climate-based goals. We are not, and we will not be, a climate policy maker. Thank you.
Excellent. Thank you all four for these lucid remarks. Now you'll have a chance to agree or disagree with anything the other panelists just said, or you can also get into one of our main questions that you didn't cover in your initial remarks, especially if you have views on desirable reforms of central bank independence and mandates. Mervyn?
Well, I just want to say how strongly I agree with what Jay Powell just said about mandates. Independence from politicians is a great responsibility, and it cannot be misused by trying to creep into areas which have not been explicitly delegated by the appropriate political process. And the way I think about it is this, that nobody would ever create a central bank to prevent pandemics. Nobody would ever create a central bank to combat climate change. They would create a central bank to try to ensure price stability, and they would create a central bank in order to try to maintain stability of the financial system. So I think if you're going to have central bank independence, you should always remember the maxim, which I think is crucial for any agency, which is only do what only you can do. And there are plenty of other people who can take measures to combat climate change. And I worry that people, in the great enthusiasm for doing good, are actually putting at risk central bank independence.
Others? Ken?
Well, not necessarily to the three questions, but just expanding slightly.
Yeah, please.
I think, particularly when interest rates were hovering around zero, one of the challenges to central bank independence was the idea we don't need it for stabilization policy anymore. That's very popular among a significant group of academics. In fact, if you look at a poll of the American Economic Association and compare what they said in 2000, where that was not considered to be a good idea by most, the considerable majority did think it was a good idea by 2021. And no one introduced Torsten, but he's made giant contributions in political economy along with his co-author Guido Tabellini, also Lars Svensson, who's here, and the late Alberto Alesina. And this just seems to have been forgotten, that I will see, I'll pick on him, Paul Krugman, draw an IS and LLM curve, and he says, well, you could shift the IS curve, that's fiscal policy, or you could shift the LM curve. You can kind of do one or the other. Well, I mean, fiscal policy is actually the sum of tens of thousands of different policies which are hardwired politically, and the fiscal policy is absolutely necessary in many cases. And of course, when a catastrophe, a pandemic, a financial crisis hits, it's less political. But in most cases, the independence of the central bank gives it this ability to approach things more technocratically and fairly quickly, that where fiscal policy needs time to sort out the political dimensions of things.
Yes. Well, I mean, one reflection that I have when I listen to the panel here and also looking at the questions how central bank independence has evolved over time, I think it's certainly important that we also see it as a generational issue. So to what extent does the young generation, I think that was very interesting what you said, like in the 90s there was still the memory of higher inflation, and I also alluded to the discussion of the situation in Germany in the 50s, where actually the politicians seemed to be tempted, when you read the account of the historians, to have a little bit less independent central banks, but the public was still so much aware of the high inflation that they pushed that the public opinion pushed towards more independence together with the U.S. authorities at the time. And I wonder whether today we're reaching the younger population and explain to them why central bank independence is so important. And I think that's also part of our outreach that we have to do.
Jay?
So I'll admit to not really answering the third question. But I'll take a shot at it now if I can. The question being, did either the global financial crisis or the pandemic and the responses to them, does it suggest that there are problems with the mandate, unforeseen tensions between either financial stability and monetary policy and that sort of thing? And I guess I would take the position that would not be my takeaway at all. I think what happened in both crises is that central bankers used their tools pretty innovatively to deal with exceptionally unforeseen and difficult circumstances. I think the main takeaway from the global financial crisis was the need to build a far more resilient core of the financial system. And we did that. The banks did that. We did that. All over the world, people did that. And I think that financial system is now substantially more resilient and more strong at its core. I think it held up better in the pandemic as a result. The pandemic was a different thing. It was it called for a whole of government response from a medical standpoint, and it called for use of fiscal policy and monetary policy tools in unprecedented ways. There had been a concern in the United States that Dodd-Frank had too limited the Fed's authority under Section 13.3 to do facilities and lending. The new system actually worked quite well. What it did was it required the Treasury's, the elected part of the government's approval for these emergency lending facilities, and that actually worked very well. And that's actually an appropriate thing, because these are extraordinary measures. We only have the authority during emergencies, and to have the elected government approving it, it was a very constructive process between us and the Treasury. So I guess to take a step back, I think that the tools that we have work. I think there's nothing wrong with our mandates. I don't see anything about the laws that govern us or provide our mandates that needs to be changed, and it seems to have worked pretty well in these two very difficult circumstances.
Yeah, that's interesting. Yet there is somehow, at least to some of us, a difference in the reaction in the 90s and the reactions now. So in the 90s, the public enemy number one had been inflation, as Mervyn and Ken had discussed, and that was an outcome of a decision making that wasn't useful and was subject to these credibility problems. And what we tried to do then was to construct a more robust framework in terms of institutional reform that would produce better decisions, that would keep inflation low. Now the public enemy number one, arguably over the next 25, 30 years, were these repeated financial crises or risks of financial crisis. And it's true that there was, of course, much more regulation of the financial sector, but not to the same extent, trying to address by institutional measures the underlying decisions in this arena. By banks, yes, but not necessarily by policymakers. So is there a case, Mervyn, you have strong thoughts on who should be responsible for financial stability and macroprudential policies? Do the events that we went through during that dramatic era of the great financial crisis made you rethink those issues?
Well, I think the answer is yes, because when the Bank of England was made independent in 1997, actually both the then governor, Eddie George, and myself were quite content, despite some press speculation to the contrary, that bank regulation would go to a separate body. But the reason was that at that point, supervision of banks was really all about depositor protection. It was about elimination of insider trading, fraud, etc. It wasn't about a historical bank run and about inadequate prudential regulation. And in the 5 years before the financial crisis, that's when you saw the leverage of the banking system increase very rapidly, so that it did become very fragile. And I think after that, I was very struck that when the to-be Prime Minister David Cameron and George Osborne, the Chancellor, came to see me, their argument for putting regulation back in the Bank of England was essentially that the only institution that people will trust is the central bank. Therefore, you need to take some of this back. Now, you can argue, I think, whether some of the details of regulation needs to be inside or outside the central bank. That's a less important thing. But the principles of ensuring, as Jay said, that the banking system was sound, I think are ones that central banks have to be involved in. But deep down, it seems to me the big difference between the way policy was set in certainly the 80s and early 90s and today is this business of recognizing that the quid pro quo of central bank independence is communication, explanation, and clarity of that communication. The great American economist Bob Solow once said that an economist needs 3 qualities: faith, hope, and clarity. And the greatest of these is clarity.
Excellent.
Torsten, can I just say something in response to your comment? I mean, inflation's back. So yes, if you'd asked that question in 2021, maybe, people said, well, financial crises, but I think you need a framework that, as Jay was saying, is stable over the full cycle of things that are happening and doesn't get, it gets tuned, but and also, let's look at the rest of the world, please. I think if we're looking at developing economies, emerging markets, which are also struggling to find frameworks, that I wouldn't tell the IMF to change what it's doing in terms of central bank independence.
All right. So maybe we'll go to the section when the public is involved, a Q&A session. So if you want to say something, please raise your hand. If you want to pose a question, if you do get the mic, please start by saying your name. Please be succinct, and please try to relate to the overall theme of the of the panel. Okay, Richard Portes, please.
Yeah, we're coming through. Richard Portis, London Business School and European Systemic Risk Board, where I have learned over several years a great deal from Stefan English. No more of that now, but maybe later. I'm not totally convinced that we now have a resilient system. Mark Carney said that in 2017 as his final statement from the Financial Stability Board. But then the banks, yes. But we found in early 2020 that that wasn't true of the non-banks, in particular the money market funds, and the central banks had to step in. Central banks don't like to do that, quite rightly. They don't like to have to act as market makers of last resort. And that may be a compromise of the mandate. So the questions that I would put to the panel, as we've seen, we've seen very recently, the rise in nominal rates is exposing financial fragilities in the system. They came from the search for yield, whatever you want to call it. And we saw an extreme example of that in the United Kingdom in September of this past year. Now, in those circumstances, should financial stability be explicitly in the mandate? Should we be recognizing reality, what central banks actually do in practice? Would that help avoid financial dominance if it were in the mandate? Given the huge costs of financial crises, is financial dominance in a sense inevitable? Recognize reality and put financial stability in the mandate. Why not?
Who wants to take a stab on that?
I mean, in a sense, it is in the mandate, most central banks now. And I think it needs to be linked explicitly to the instruments of central banks. This was the problem before. And the obvious instrument is, whether you call it lender of last resort to banks or the equivalent to the non-bank sector. And I think that the central banking community is very focused on the question of defining the circumstances and the nature of institutions that happen to be non-banks that would merit an intervention. And I think that the only way to handle this is to have a framework which is set out ex ante, which actually tries to identify clearly the circumstances and the institutions that would merit lending from the central bank, but also ensures that the scale of that intervention is also under the control of the central bank and not something which the actors themselves in the financial system can expand to almost any number simply by the actions that they take. It's ensuring that there is enough collateral against which to lend by the central bank. Now, I think the central banking community is well aware of these problems. It doesn't make them easy. It doesn't mean that you can do it in a week. But my guess is, yes, you're right, Richard, that there will be an expansion of the mandate and that it's there in principle, but it needs to be made much more concrete by saying, what are the institutions, what are the circumstances, whether it's maturity mismatch or something else, that would justify an intervention, and to have sufficient regulation on that degree of maturity mismatch ex ante to limit the size of the intervention.
Claudia?
Yeah, no, I agree that to some extent the framework for central banks to be involved in macroprudential policy is well defined. So the Bundesbank, according to the German financial stability law, has a clear mandate in that regard. It's a joint mandate with the supervisory authority and with the Ministry of Finance, because as we all know, there's a lot of distributional implications that macroprudential policy decisions can have. So it's not us alone. And I think also the ECB has clarified in its strategy review how monetary policy and financial stability interact. The one point that I would like to make in addition is that we also do have frameworks for evaluation of policies and whether we've done enough. So the FSB, the Financial Stability Board, started this big project in 2017 and looked at the reforms that have been implemented, found no major side effects, found that a lot has been achieved, but there are still also gaps when it comes to resolution reform. So I think also for the areas that you mentioned, the non-bank financial intermediation space, we clearly have to implement policies and look at the resilience in that part. So I fully agree. We can never say that the job is done and we can all lay back. That's what we're there for.
Jay, please.
Just to add, in the same spirit, I think that what the pandemic revealed was weaknesses in the non-bank financial sector, much as the global financial crisis revealed those weaknesses in the big banks and the large utilities, financial market utilities. And so there has been, as Claudio was saying, and Mervyn was saying, there's a lot of effort going into and has been in what do you do about money market funds? What do you do about the treasury market? These things are much. And I think the first order answers need to be changes to the structure of these institutions to make them stronger, more resilient on their own. I would say expanding the provision of central bank liquidity is not the desired response. It really is to strengthen these institutions. Our capital markets are quite vibrant and very different in what they do from what the banks do, and I wouldn't want to see the kind of prudential regulation that goes along with liquidity provision. I don't think it wouldn't be great to extend that too much into the non-bank financial sector. I'd rather work on structural reforms, which is kind of what we've been doing.
Claes Eklund.
Thank you, Torsten. You mentioned that you did graduate studies together with Stefan. I can add that I actually made undergraduate studies together with Stefan, so I'm even older. But a question of independence. It seems that you have mainly been discussing central bank independence from, let's call it political pressure, and of course partisan pressure would be even worse. But there's something more subtle about the independence issue, which I think we can discuss in Sweden right now. I'm personally interested in that. I worked in the finance ministry many years ago, but I was also on the general board of the Riksbank, Riksbanksfullmäktige, not the board of directors, but the general board before, in the old evil days before independence. Anyway, in Sweden we have 4 institutions: the Riksbank, the Financial Supervisory Authority, the Debt Office, and of course the Minister of Finance. And they often work with similar issues, obviously. And they often have to cooperate. So the question here is, how independent can the central bank be in reality? To what extent must the central bank discuss, compromise, lean against the wind or with the wind, and be politically agile at the same time as it is formally independent? Maybe it sounds like a stupid question, but I think actually this is almost as important as the, let's call it, the big issue of political independence. I'd like to hear sort of your experiences from this. How independent can the central bank really be?
Can I start by saying, I think we have to distinguish between monetary policy independence, where the case, I think, is very strong, from all the other activities of the central bank. So as a regulator, the United States, Fed's very powerful, but there are many other regulators it deals with. And I think the same is true in most countries. So that it's very different conceptually, and I think all regulators, we'd like to be independent from over political influence and being bought off, or, even if it's only psychically held hostage by those that it regulates. But I think that's, the central bank in general, and looking at all its functions, it clearly has to coordinate with other agencies. It clearly has to be subordinate to political policy, as we had in the first session here.
So I can speak from my experience, which was that between 1997, when the Bank of England was made independent, and 2013, when I left, there wasn't a single episode where the elected politicians put pressure on the bank to adopt one interest rate policy or change rather than any other. Whereas, as Jay talked about, the facilities that were put in place in the US under the new regime, which was meant in some sense to give more control to elected politicians, we in the Bank of England in 2010 really introduced a compact between the Treasury and the Chancellor on the one hand and the Bank of England on the other, which said that any lender of last resort operation had to be approved by the Treasury. That seems to me perfectly reasonable and appropriate. And you have a private conversation where you explain why you want to do it. And in very few cases could I imagine that the Treasury would say, if the central bank feels that a lender of last resort operation is appropriate to prevent some collapse, the idea that the Treasury is going to say you can't do it, I think is not likely to be true. But since taxpayers' money is at risk, it's perfectly reasonable for the Treasury to have an input on it. There was never any conflict between these two different approaches in the different areas of policy. So I think the important thing is for it to be quite clear what that policy responsibility is, whether it's in the US with changes in legislation or the compact agreed between the bank and the Treasury in the UK. It's quite clear what the lines of responsibility are and who has to be consulted. That's the important thing. That's what prevents, I think, things going very wrong. It's where different institutions or players all feel that they are the people responsible for a particular policy that you get difficulties.
Yeah, or to express it differently and perhaps more simply, it's a big difference between taking the decision in deliberation with others or taking it after deliberation with others.
Yeah.
And that's the responsibility point, right? So, yes, please.
Thank you very much for the panel. Joachim Nagel for the Bundesbank. Let me put it like this. I think it was already said by Ken Rockoff. I think inflation is back now. We are more or less, in my interpretation, still in the midst of a storm, and the storm is not over. So we have to do our job, our main mandate. This is our role. During the last 10, 12 years, we were the most welcome partners of the politicians because we, in our independent role, we did everything to fight against all the financial crisis and did what we did. But this came with a price. And now in the next years, the politicians have to learn that monetary policy is coming with a price. So maybe some of us, they have to announce that there are maybe losses or not the profits we came up in the past. What is your opinion about that? Is that influencing the way we are being perceived in the future about our independency?
Who wants to take that on?
Well, I'll take it on. It's related to something that I said, which is that the pressures from politicians will be greater and more complex today than they were in the 1990s. And you're absolutely right. But I don't think it's an issue about the mandate of the central bank. That is unchanged. It's that some people in positions of political responsibility will learn that life can be difficult. But I don't really see that there is a great wish anywhere to change the formal independence of central banks. But politicians will always want other people to do things that would benefit their own short-run interests. That's where central banks will remain solid and maintain their independence in respect of monetary policy. And they have every incentive to do so, in my view.
Someone else? No?
Well, I'll add briefly. I mean, clearly, there are many cases where, given the central bank's independence, politicians will look to the central bank, as Mervyn saying, to do something they should do, but they don't want to do, or political interests will say want something to do with inequality or something to do with the environment that they're not getting through the political system, and they'll view the central bank perhaps as an end around being able to implement it. But of course, at the end of the day, the central bank can't take political decisions consistently and maintain its independence. There are deep crises where the central bank just has to act. But I think in that case, it again is looking to the political system to back it up. If you go to developing economies, the normal rhythm of things is the central bank moves, but then the Treasury kind of takes over everything it did, and everybody knows that that's coming, and so it works that way because the central bank can move so quickly. But it needs to be very wary of taking political decisions.
Stefan.
Outside the topic of the panel, but since Ken, you are on the panel, I'll ask you anyway. You wrote a nice little book called The Curse of Cash. And in this environment, cash is disappearing. So what's your advice?
Well, isn't it wonderful that the people who organized this event had a panel just before us about this? But no, I think one of the things that's been very naive about I will call them crypto evangelists, is that they can somehow do something better and have an end around. And in fact, if you look at the history of money, which is probably what I should have called my book, and you look at the private sector always invents everything, but for many reasons, the governments eventually regulate it and even sometimes appropriate it. And I think, that's what we're seeing going forward in the digital space. You need rules of the road. And I was going to bring it up earlier, but I have to mention FTX. That was kind of a success for the regulatory community. It didn't do anything. It's the $32 billion at the heart of the crypto system just had no effect. And I think it shows how you need some regulatory structure to provide guardrails, and the central banks need to do that. But anyway, I've learned from you over the years on this issue, so thank you for asking that question.
Since we're spiraling out of control here with questions about anything, we should try to wrap up. So all good things must come to an end, and I'm not going to try to summarize what has been said, but I'd like to end with some final remarks. But really just 1 minute for each of you to summarize for the audience, which is the most important thing that we should take away from the panel. If you had to expound on one, which would that be? Who wants to take that first? Jay?
So I'll just conclude by saying that for us, central bank independence is a matter of statute. It's not in our Constitution. It's just an institutional arrangement that has served the public well, nothing more, nothing less. And as long as it does serve the public well over time, then I think it's safe, and I think it's safe now. But that means we've got to be committed to achieving our goals and to sticking to this precious grant of independence. To keep it, we need to deserve it, and that means stick to that work and don't look for broader things. Where it was discussed at the first panel, really, we shouldn't be getting ahead of where the public is if there's no specific mandate. And in the case of the U.S., that's a particularly salient point today.
Claudia?
Yeah, no,
It's your bottom line.
I fully agree with what Jay just said, and that's also, again, when you look at the German history, so sticking to the mandate and deliver. I mean, this is what's building trust, and I think when it comes to financial stability, we're actually at a critical juncture because the system has not been fully tested, so we have to make sure that we also deliver on both of our mandates, price and financial stability.
Erwin?
All good things do not have to come to an end, and central bank independence is one of them. And I think the point that comes out of all this is you can have a debate about whether interest rates should go up, and if so, by how much, or go down a bit. That's to do with the actual decision that's being made in a moment. But institutional arrangements matter. They really matter, and that's why central bank independence, I suspect, will live longer than many good ideas.
I also believe central bank independence will go on for many decades to come. It's hard to know forever. And I would just again argue, as I said in my remarks, that it's really been maybe the most successful policy innovation post-World War II and continues to be.
Okay. Let's stop at that and take early coffee. Thank you, with a big applause to the panel.
Thank you.
Okay. Great.
Okay. How's it going, everybody? How was that for y'all? Nice little Jay Powell speech. Nothing really came out of it. Who would have thought? This is exactly what I said yesterday before this happened. So they're basically talking about the Fed's independence and specifically on the topic of climate change. And the big idea that I got out of it is Jerome Powell said that it's not my job and I don't care about climate change. So he's not falling into the political pressure that's being placed on him by the media and the state to push for more and more climate change. I think that's actually a good thing. I think that means that we're not just going to have reckless fiscal spending. So I see it as bullish. And this was really kind of a non-event. There was nothing that came of it that we didn't already know for the most part. So my assumption is that we're going to be trading flat or up today. So I opened a put credit spread. Donald Trump had a nice purple speech, or a nice purple tie in the speech. Powell is juiced. Don't be fooled. Yeah, they really are. They really are. I mean, the Fed likes to claim independence, but the Fed chair, Powell, was appointed by the U.S. president. So how is there no political pressure in that regard? If the president of the United States is the one that's putting this person in office, he's going to have some political pull. But the Fed can claim independence all they want. We all know that it's bullshit. But I did like that he, at least gave the illusion that they're not going to cave into the political pressures and do whatever the new thing is. Climate change, right? Of course, we know we need to fix the fucking climate. But that's not on the backs of the fiscal policy makers. Why is it their job to make sure that the climate is, getting better? It's really on the backs of people that are creating and actually putting in the work to get us to net neutral. And, electric vehicle makers. It's more on the backs of electric vehicle makers or people that are making wind farms and stuff like that. It's not the Fed's job to do that. The Fed would be horrible at doing it themselves. They're not made for that. But there's businesses that make these products already, so let those businesses make those products, and they're going to do it a lot better than the Fed can, and a lot better than the U.S. government can, because we all know how inefficient our government is. It took 15 votes to put in McCarthy as the Speaker for the House. Ridiculous. So I don't think that it's on the backs of fiscal policy makers and the government to push for climate change. I think it's really on the backs of the people that are already making the products. So that's my stance there. But got some trades open right now. A put debit spread, assuming that we're going to be under 386. Tomorrow, I might actually take profits on that. My assumption, we're probably going to go up or flat. Today, we don't have any economic data coming out today or tomorrow. So I have an iron condor that's assuming that for tomorrow. Tomorrow's expiration 111. Right now, that is trading for 17 cents a piece. I want to try to get it out at 15 cents a piece. That's the goal, at least. Right now, the bid ask is super wide. Thank you, Robinhood, for always screwing me over on prices. But the put credit spread that I opened during the speech, that one should be doing pretty well. It really hasn't gained much value at all since the speech concluded, and we've gone up. We dipped down to the price level at 387.25, which was the open this morning, and the 200 moving average line that one of our people asked me to put on here is just above it, so I think we're probably going to trade above the 200 moving average line. If I had to guess. I'm going to remove it, though. The only time that I use moving average lines is when it's really necessary. So for me, this would be something like finding the 30-day average of the price of oil. So if we go to the daily chart, edit our studies, and add the simple moving average, we can change the settings to make it a length of 30. So that'll be 30 time frames or 30 days since we're on the daily chart. The 30-day average of oil prices has actually come down. For the month of December, it was an average price of 77.5. And then for the month of November, this was 85. So that is 10-point drop on the price of oil over the course of a month, which is about an 11% drop for energy prices, which is a positive for CPI. Core CPI might not be affected as much just because that excludes oil and gas, which coincidentally is the things that we pay the most for or pay for the most often. But we did kind of just trade flat for the most part since 12/12. So I'm not sure if the moving average will be entirely accurate to determine what CPI is going to be, but my guess is that it is going to come in lower than it was the month previously. For December, it was 7.1. The Wall Street geniuses think it's going to come in at 6.5. So if we head on over to the economic calendar, again, we don't have any events today or tomorrow, so don't expect any major volatility, especially after this Powell speech has concluded. Really nothing going on between today and tomorrow. And then on Thursday, actually, we do have a 10-year Treasury note auction. That could actually trigger the markets in one direction or another, just because that will affect interest rates. So whenever the Fed sells bonds off their balance sheet with an auction, that is creating more supply, which means that the price should go, let's see, if supply increases, then the price of it should go down. So the bond prices will go down. That has a negative correlation with interest rates, so the interest rates will go up. So the way that you can think of it, if there's more bonds that are available on the market now, say you're going from $1,000 worth of bonds to now $2,000 worth of bonds in the market, and you have a pool of 20 people wanting to buy these bonds, now those people are getting 1,000 versus 2,000. They're getting $100 per bond versus just $50 per bond whenever they were getting $1,000. So that's the way that you can kind of think of it in the supply and demand of these bond auctions, buying and selling bonds, and the interest rates and the prices have a negative correlation. So whenever the price of the bond goes down, the yield goes up. Is the auction on Thursday? No, it's tomorrow, Wednesday. And that's the 10-year, which is like the most popular. But after Wednesday and the 10-year Treasury note auction, we have CPI coming out on Thursday morning. Again, this is expected at 7.1, 6.5. Last month was 7.1. I think, and this is just a rough estimate, I really have nothing to base this on. The last time I was able to base it on the producer price index coming down by about 10%. But this one, the PPI or the producer price index doesn't come out till next week. So this is just purely my best guess. That's all I can really amount it to. But my best guess is that it's going to come in slightly higher, and it's going to be 6.6 to 6.7%. We did see the ECB, or the European Central Bank, come out with much lower CPI numbers. It was down about 10%. I forget exactly the numbers. But if there is a 10% drop in CPI similar to Europe, that would put us at a rate of 6.4% inflation. So if it comes in 0.1% lower than what's expected, the markets would be pretty bullish on that. Usually whenever that happens, the markets rally anywhere from 2 to 4%. My guess, if it comes in at 6.6 to 6.7, which is my best estimate, is that it's going to drop anywhere between 1 and 3%. That is from the close of the day before. So the close of tomorrow. And not exactly sure where we're going to close tomorrow. My assumption is we're going to trade flat for the next 2 days. But yeah, my analysis, we're going to get 6.6 to 6.7. It's going to be just a slight miss. Probably going to sell off just a little bit, like 1 to 3%. Usually these, CPI events trigger like 3 to 4% moves, so that would definitely be on the lower end. But SPY is making its way up to that 389.76 mark, which I got from the hourly chart. So that's a good improvement for the market. That means that our put credit spread is probably making us some decent change. Currently at $45 in profit for that trade. And then I have an iron condor. This one I think I'm just going to get out of. I really hate the bid ask on Robinhood, but the bid is 17, the ask is 21. We might be able to get out at 20. I really want to get out at 15, but I know Robinhood's going to screw me over on the prices here. I'm not going to get that even if I sell my soul. All right, well, I might be able to get out at 18. Maybe. If I'm lucky. So I have 8 of these that I'm going to try to close at 18. The ask is at 19. Now it's 21, 20. So the likelihood of getting filled on this is very low, but at least it's worth a shot. Why not trade on Thinkorswim? Thinkorswim doesn't really have that much better of bid-ask spreads or fills. E-Trade has some of the quickest and best fill prices, and they charge the same amount of commission. So if you want like the best fills and you're okay with getting charged a 65 cent commission, I would go with E-Trade versus Thinkorswim. Thinkorswim is very nice in that it's very adjustable with the charts and everything. I don't know if E-Trade is exactly the same, but yeah. I would definitely prefer E-Trade to Thinkorswim if I'm paying the same 65 cents in commissions for each option that you open and close. Looks like these aren't getting filled at 18. We might try 19. I really hate this, but sometimes you just gotta bite the bullet. Maybe we just close a few of them and not all of them, because I still think that we're going to trade flat between today and tomorrow. I do think that the risk could be to the upside just because this Fed Chair Powell speech was a relief. People thought that he would be talking about higher interest rates. Turned out just to be all about the climate, which doesn't really matter. I mean, it does in the grand scheme of things, but it doesn't really matter to the fiscal policy. So, a non-event, which means that either we're going to trade up or flat today. And I'm going to try to close 5 of these now at 19 cents. So I have 8 total. I'm trying to close 5. And Robinhood is trying to rip me off. Do I still have my BLK spreads open? Yes, I still do. I will get to those after I can figure out how to close this damn iron condor. All right, I'll close half of them at 20. I will negotiate with these assholes that we call Robinhood. So I close half at 20. I want to close the other half at 15 or lower. We'll see if we can actually get that or not. But just taking some risk off the table here. think it's appropriate. Given that, I do think that we might rally today after the Powell speech not really amounting to anything, and people got scared over nothing, basically. But closed half of the iron condor position. That is not a screenshot. Not the screenshot that I want, at least. There we go. That's better. And now, of course, the prices drop on them to where I could have sold them for probably 18 or 19, but whatever. Closing options alert. Premium 101. All right, just took profits on 4 of 8 SPY iron condors. These expire tomorrow, 111 at 20 each. Strike prices were 381, 382 to 385 or 395, 396. And I still have the other 4. Now the ask dropped to 19, the one that I wanted initially, but I never got because screw Robinhood. Do I still have the BLK? Yeah, let's talk about the BLK. Currently, they're down about 46%. BLK is trading at $750.33 right now. My assumption is that they're going to drop on their earnings report, which is coming out on Friday morning. Now, this trade might not fare well today, given that the overall markets are going to go up, which is going to put upward pressure on BLK, just because it's going to trade with the rest of the market until the earnings comes out. But I'm assuming that we're going to head all the way down to $730 by the end of next week. So my expiration date is set for 120. And these are the price levels that I've got set up for right now. I have 747 is the closest support, 735.41, 730.27, which is the one that I think it's going to head below after the earnings report on Friday morning, 724.50, 718.86, and you can read the rest. And then the next resistance is 762.16, which it got rejected by yesterday, and then 788.41, which is the top of the risk range as well. So likely not going to head above $788. There is a chance, about a 1/3 chance that it does, but I wouldn't be a betting man assuming that it would go that high. I think that banks are going to have a pretty rough earnings season, just given the slowdown in lending over the last few months, especially if you look at new home sales and existing home sales. Both of these trends are god-awful. This is the new home sales. And if we shorten our time horizon to, say, 2020, this has actually rebounded a little bit. I guess housing prices have come down enough to where people can start to afford homes, but I think that generally it's not going to be a pretty earnings season for banks. I wonder if you can look at new vehicle sales too. That would be an interesting measure. New vehicle sales. Total vehicle sales. That's a decent measure if we go back to 2020. This is actually up the last few months too. Interesting enough. Why did we trough in May through August? That's interesting. June through September is the second quarter, and then this would, or the third quarter, and this would be the fourth. October, November, and then December, which we're missing right now. Kind of wish that we would get an update on it to see what it's actually looking like right now, but we have old, antiquated data. Let's see what we got. This put debit spread that I have open, this one expires on Thursday after the CPI. I think this still works. And I'm going to hold it into the CPI report. I put on $340 of risk for this trade. I think that's appropriate. And then the put credit spread that I opened this morning during Powell's speech is currently going for 24. Right now we're trading at 388.69. So we went just above that 388.76 mark and then got rejected. But the trend is certainly up this morning. We got a higher high, higher low. Well, I guess slightly lower low, so maybe we do trade flat given that. If we look at our studies, just looking at the simples, RSI and MACD, RSI is currently above 57, so that's bullish. As long as it stays above 50, that is a bullish sentiment. The MACD is starting to curl over, possible crossover, but I don't give as much attention to the crossovers in the MACD as I do to the RSI. RSI is a very good indicator of current sentiment. Right now it's at 58. As long as it's above 50, again, that's bullish. If it's below 50, that's bearish. And then if it's around 50, so if it's between like 40 and 60, that's generally just neutral. I'll get rid of these studies. We don't really need them. Pretty obvious that we're trading up this morning so far. Could always change, but let me remove the studies. And let me make sure that I have all of my trades logged that I've opened and closed today. The January log, currently working on this spreadsheet right here, which will tell you each strategy and your profit and loss for each strategy, the average percent profit and loss, number of trades, and your win rate. Probably going to add a few more metrics that I want to measure. But it's been a pretty good start to the year. All profits last week. Doesn't look like it's counting the right days. I put 12 instead of 1. So let me edit this to make it correct. All right. So I made $337 yesterday on Monday. Not a bad day. And let me head on over to the January log. Make sure everything is updated. So that SPY put credit spread we still got open. So don't need to type anything in there. We got rid of the call debit spread. That one we got rid of today. That one we closed ourselves. It did not expire. And that one I took a $119 loss on. So sucks that we took a loss, but that is the name of the game. And this one I actually haven't closed yet. So this was an example that I recorded earlier. But let's see. Get rid of the date here. And this is a SPY put debit spread expiring 1/12. Assuming SPY is going to be under 385 on Thursday. So this is for the CPI. I risked about $350. And I think that trade is pretty likely to work out. I think we're going to get roughly, again, my estimate is 6.6 to 6.7% CPI. And if it comes in slightly worse than expected, we should sell off about 1 to 3%. Right now we're trading at 390-ish, 389. So not really much of a move that we need to the downside, just about 1% from where we're currently standing, but that is based on tomorrow's close, which obviously we don't know what it's going to be yet until tomorrow at the close. But my assumption, we're probably going to trade flat these next couple of days, and I would probably put it between 396 and maybe 384 would be my guess. So an iron condor between 384 and 396 would be ideal. I already do have an iron condor open right now. If we head on over to the Robinhood, I'm assuming that it's going to be between 382 and 395. We could widen that to 396 to be safer on the upside. Not 100% necessary, though, I don't think. I do want to maybe check out how much we would get for the 380 or 396, 384 Iron Condor that expires tomorrow, just to get an idea. Maybe we open another one. So that one's going to expire tomorrow, January 11th, and assuming that it's going to stay below 396. So it's like opening a call credit spread, assuming that it'll be below 396 and then above 384. So like a put credit spread, assuming that it would be above 384. And that trade right now is going for $19 of credit. So you're risking about 80 to make 20. Not the best in terms of risk reward, especially for an Iron Condor. So not a trade I'm willing to make. Yeah, we got a little bit of a top just above that 389.76 mark, but didn't quite get through it. Still bullish with the higher high, or higher low, I'm sorry. Well, we cracked that higher low just barely. So maybe if we head down to 387.80, could get a bit of a sell-off here. See if there's any news that might trigger the markets in one direction. U.S. regulator says traffic death cost U.S. $340 billion in 2019. That's really old data, but not really surprising. Each person that dies in an accident with the average salary about $50,000 is $50,000 less that's being put into the economy. So if it's 340 million or 340 billion, Jesus Christ, that's a lot. 340 000 000 000. That's a whole lot of zeros divided by 50,000. 6.8 million people died in a car crash. I don't believe that. Maybe we have too many zeros here. 6,800 seems more likely, but not really important here. But that put credit spread currently down 25. I might exit, just given that we cracked that higher low, might start to trend down. My assumption is that we're still going to be flat the next couple of days. But right now we're breaking down. So maybe we get a bit of a sell-off down to the 387.25 mark, which would not be ideal for these put credit spreads. Yeah, it kind of looks like that's what we're aiming for, that 387.25 mark that we opened at. Hopefully we don't head too far below it. If we do, these are going for 37 at the moment. Got 5 of them that I opened at 26, so I'd be taking about a $50 loss. Jesus Christ. These are getting overpriced now at 40 cents. I'm not going to give them up for anything more than 38. Looks like we might have got a double or a triple bottom right there. First bottom, second bottom, and now might be a third bottom unless we cross below. Luckily, we leveraged to the downside with the put debit spread we opened for CPI coming out on Thursday. So we make money either way. It don't matter to me. Don't matter to me. This put debit spread, yeah, this one's up 120, so this is making up for the loss that we're taking on the put credit spread that I opened that expires today. So far, bouncing off that 387.25 mark that we opened at. No cross below yet. UN Nick Haley says, Nikki Haley tweets, when the left gave the IRS $80 billion to hire tens of thousands of employees last night, House GOP voted to repeal that funding. Every Democrat voted against it. Yeah, I mean, we need less government spending overall, and I feel like the IRS could be automated for the most part. Hashtag abolish the IRS. No. That's something old Ted Cruz would say. I do believe that we should get rid of unnecessary government agencies and replace them with artificial intelligence, just because the fiscal spending is absolutely insane and we don't need to hire more IRS people, but it is what it is. I don't get to control the government, unfortunately. Do I think the market is going to dip and rip today? Seems like it might set up. Looks like it's fallen off. We just went below that 387.25 mark. Seems significantly below, so I'll see if we chop here or if we do just keep headed lower. I got that 386.50 mark that I'm looking at too. 384.10 all the way down. I don't think that we hit 384.10 today. It's possible, but unlikely. Yeah, the put credit spread I open is currently down 90. And we're just below that 387.25 mark, so seems like we might have to close it at a loss. I'll stick around until I close it. It is 10:35, 5 minutes after I'm supposed to end these, but I'd rather show my close than have to show it to y'all tomorrow morning. All right, looks like we're bouncing here. So just more flat price action is what it's looking like so far. We could open a call credit spread, maybe hedge our bets to the downside. Actually, that would be another downside trade. That would be a hedge on our upside trade. And say right now we stay below 390. That's easy to say since we topped out at that price level. We're at 387 right now, so I don't think that's going to pay much. The risk reward might not be great for it. But if we're looking at a 390, 391 call credit spread, currently that's paying 13 cents. I don't think it's worth it. Maybe if we head back to like 388 or so, it could be worth it. But for right now, it doesn't seem like it's a worthy trade. But it looks like so far we got... Whoop, and that is too close. Looks like so far we got rejected by the 387.25 mark that we opened at. Hopefully we reclaim it and go to 388 and above for the put credit spread side, but not sure if we're going to get it. Right now they're going for 40-ish, 42 cents at the ask price. I don't think that they should be valued more than 40. So I don't want to give them up at 43. I don't want to overpay to close it. So I think I'm just going to wait. Just going to wait on it to hit 3 or 40 cents each and maybe close at that point. Right now they're going for 44. Really not worth it. If we head down to the 380, 650 mark, then they should be worth 50-ish. But right now they're just very, very pricey. About 10%, 5 to 10% overpriced. We could use that to our advantage and open more since they're overpriced. And now we're headed back to that 3 to 725 mark one more time. We'll see if we blow past it or if we get stopped again. Looks like we went slightly past it. Probably need to peek our head above like 3 to 760 if I had to guess to reclaim it. So we'll see if we reclaim it or not. $60 mark is what we're looking for, 387.60, which is about the halfway between the open and close of that last huge candle of significance. All right. Kind of looks like we're holding above it for right now. The bid is at 387.28, 387.27, so slightly slipping on the bid-ask spread. I wonder if we can look at the active trades, decreases to make it less apparent, but right now there's more people that are trying to more buy orders than we have sell, but the sell orders are much larger in contrast. All right. Yeah, it looks like this candle held above it. At that 387.25 mark, it just landed at 387.29, 28, somewhere around there. So looks positive. Maybe we can close these at a small loss instead of when they were trading at 42. Right now they're trading at 39. I've got 5 of them. And again, we're looking for that 387.60 mark. Right up top here. I'll make it a apparent. 387.6, and I'll make that red since it's on the 5-minute chart. Candle of significance, so it's just going to have 1 for the width. Oh, that is too tight. Too tight there. There we go. All right. Maybe we don't get there. That's what it's seeming like so far. I'll try to close these at either 39, between 38 and 40 cents each. Right now they're going for 40. I think that's actually fair value, so I might just try to close it there. Still a little bit overvalued, actually, since it's trading at 387.20. So let's try to negotiate with them at 39 cents each. We just broke below that mark, so let's get out at 40, I guess. Oh, boy. Yeah, kind of looks like we just got rejected by the 387.25 mark. So cut our losses. Open them for 26, close them at 40, so 14-cent loss for each. Around $70 of loss. And it looks like we're headed right back down, so let me post this to the premium Discord ASAP, and I will log it to my trade log, and that will be the end for today. All right, so closing options alert, premium 101, premium, just cut losses on the SPY put credit spread that expires today, 110 at 40 each. Strike prices were 386, 387. I'll type it on in here. Now they're going for 42, so slightly higher in value. Let me make sure I log the trade before I forget it. Oh, come on now. This is not working like I want it to. Yeah, we're down to that 387 mark again, so I probably should have set my strike price a little bit lower on that since we opened at 387, basically. Might have should have called it like 385, 386. But hindsight is 2020. Can't always make the best decisions every single day. Just gotta try to refine and improve for the next time. This one I closed today, and I close them at 40 each. So $70 loss there, 120 from the one that I closed this morning. But still making profits off of the iron condor that I have open. Still making profits on my put debit spread. Should be doing pretty well with this price drop. Currently they're going for 50 cents each. I bought them originally at 34 cents, so right now I'm up by 150. Still think that CPI is going to be a negative and drop us well below the 386 mark, especially considering that we're already trading at 386 right now. But again, this is based on tomorrow's close, which I think will probably, if I had to guess, will probably be between 384 and 396. So 384, 396, 780 divided by 2. Roughly $390, probably give or take like 1.5% or 1%. So 396 to 404, or sorry, 386 to 394 is where I would assume that we close tomorrow. So if we discount 390 times the at least 1% drop that I'm expecting, we should head down to 386 and below. If we head down 3%, we should hit 378. Currently, we're trading at 386, so that does still present some opportunity if the CPI report is really bad. But my assumption is just going to come in slightly bad, so we'll probably sell off anywhere between 1 and 2%. But yeah, that is the end of the live session today. Stayed a little bit longer just to exit out of that put credit spread, and I will catch y'all tomorrow morning, the same time at 9:30. See you, everybody.